The invasion of Ukraine by neighbouring country Russia is well and truly underway now. Russia has reportedly pushed half of its 150,000 plus troops that were sitting on the border into the country, tearing up a 2015 peace deal and putting all of Europe and the rest of the world on high alert. What I'm here to talk to you today about is the financial implications of this war, particularly on markets. Now, don't get me wrong, the financial implications are not nearly as devastating as the implications that it's having on people's lives, and that's not what this is about. But obviously, this YouTube channel is focused around finances and money and investing, and so that's what I'm going to focus on in this video. But obviously, I sympathize with anyone that's directly or indirectly affected by this war. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about the hot topic, which is the war between Russia and Ukraine. As to be expected, when the war first kicked off, investors turned to risk-off mode and it caused markets to sell down. And this is because markets in general are quite skittish. They don't like uncertainty, and there is a lot of uncertainty that comes with war. However, towards the end of last week, markets did a bit of a U-turn as investors found out that sanctions weren't being placed at this stage on Russia's oil and gas. That made markets a little bit more bullish, along with the idea or the thinking that the current uncertainty could mean that the Federal Reserve doesn't increase interest rates by 0.5% next month. By the end of last week, the S&P 500 actually ended up 0.8%, the ASX 200 was down 3%. However, markets today are looking a little bit more positive. Bond yields, gold, and the US dollar had little overall change last week. So what this tells me is that investors and the market in general are more concerned about inflation than they are the conflict between Russia and Ukraine. And this makes sense because although wars are horrible, there is very little economic ties between Russia and the Western countries, and so the economic impact of this war may not be that great. The primary reliance on Russia is in their oil and gas exports. Russia is one of the largest producers of oil in the world, currently sitting at the third largest after the US and Saudi Arabia. They are also the second largest gas producer in the world, again only trumped by the US. This is why the Western countries have avoided putting any oil and gas sanctions on Russia, and also why the market rebounded when they found out that sanctions weren't going to be placed in these areas, or at least not at the moment. Because if you disrupt that supply chain of oil and gas from Russia, it's going to lead to further inflationary pressures in a market where inflation is already the primary concern. However, we're obviously in very volatile times and things could change, and they are changing daily. But you would hope that if there is an interruption to the oil supply in particular, then OPEC would step in and increase production in that area from the US. Now, OPEC are meeting on Wednesday, so we'll probably find out a little bit more then. Russia and Ukraine also make up almost 30% of global wheat exports, and we've seen an increase in the price of wheat as a result of this conflict. Just like oil and gas prices, an increase in the wheat price is inflationary. So where do markets head from here? Well, unfortunately, that's basically an impossible question to answer. All we do know is that this war is going to continue to bring unknowns and uncertainty in markets at a time when we already got issues with inflation and rising interest rates. Best case scenario is that the war is contained to Russia and Ukraine only, and eventually Russia backs down because it's stifled economically by the sanctions that are being put in place. And so for that to work, we really need a lot of the major developed economies around the world imposing the sanctions upon Russia and singing from the same song sheet, which to date they've done a fairly good job of doing. However, the big unknown at the moment is where China sits. China has not yet imposed any sanctions on Russia, and it doesn't appear that they're going to be doing so either. A not so great outcome would be that the war continues to go on between Russia and Ukraine, and this causes further sanctions to the oil and gas production in Russia. As we already discussed, this would add additional inflationary pressures to an already high inflationary environment. Worst case scenario is that the war isn't constrained to Russia and Ukraine only, and other countries start to get involved from a military perspective. This is where things could really get ugly. And a lot of the risk here lies with China, and if they see this as an opportunity to take Taiwan. At the heart of this divide, the Chinese government sees Taiwan as a breakaway province that will eventually be part of the country again. So as an investor, what should you be doing right now? Well, that really depends on your situation and your financial plan. But in all likeliness is, if you already have a good financial plan in place, then the answer as to what you should be doing now is probably going to be nothing. I came across this great little chart by Vanguard which shows the market implications of some previous geopolitical issues. As you can see, the average total return just 12 months on from previous geopolitical events is roughly 9%. Now, this is not to suggest that you should throw everything you have into the market right now, because there are some very real risks at play. And we've talked about some of those risks that relate to Russia and Ukraine, but we haven't talked about other risks, like the Bank of America predicting 7 rate hikes this year. For me personally, this is not the kind of market that I would feel comfortable dumping a whole lot of money into. I would rather dollar cost average my way in over time. And yes, there's the old saying that time in the market beats timing the market, but for me, a more conservative approach to investing when so much is happening in the world and so much is happening in markets is to dollar cost average your way in. But if you do already have money in the markets, well, don't panic, because volatility is part of the long-term game. And if you're investing in stock markets, you should be doing it for the long term. And if you take a long-term view on this, well, it's probably just gonna end up another blip on the radar. But that's it for me today, guys. Thanks a lot for watching. Leave your thoughts in the comment section below. I'd love to know what you think about the current impact on markets and where we're heading to from here. But other than that, I will see you guys in the next one.